This week on Wealth Track, why ballooning government debt, the changing value of the dollar, and the rising treasure of gold are all on the mind of contrarian James Grant, the editor of Grant's Interest Rate Observer. This financial thought leader is next on Consuelo Mack Wealth Track. So let's talk about the value being presented to us in the present, because we've had a flight, what they call, to risk assets. Can we just parenthetically deal with that? People say there is de-risking or there is risking, new verbs. Please. Who knew that risk was a verb? I guess it is a verb. But risk is not inherent in an asset. People say that treasuries are inherently risk-free. Treasuries are risk-less or risk-full at a price. In 1984, when everyone hated them, they were yielding 14%, and they were deemed to be extremely speculative because we had been through a 35-year bear market. And who wanted 14% non-call 30 years?
Who would want something like that?
And now, treasuries, as the Wall Street Journal used to say, every single day, except Sunday when it didn't publish, it would say every single day, super safe treasuries was the invariable,
adjective.
You're right. Mm-hmm. You're right, preceding the word treasuries. They're not super safe. They, as a friend of mine said, they are return-free risk. Or, more charitably, they are an option, our treasury. They're an option on a certain macroeconomic outcome, which is perhaps falling prices and a dodgy business environment. That's where they would do well at these levels. And we might have that outcome, but they are a speculative, they are a speculation on the outcome as opposed to an investment with a margin of safety. So, people fly to risk, or they fly away from, they fly to assets that are priced for a certain outcome, and that outcome is plausible or not, and the assets are risky or not, but they are not, these assets are not inherently safe or unsafe.
But the Fed giveth and the Fed taketh away. So you think that the Fed will, in fact, at some point have to take us away?
Yes, I think that the Fed doesn't mean to debauch the dollar, although actually it kind of does. The Fed recoils at the prospect of prices merely being stable or even falling a little. The Fed wants a little lilt. It wants just a little bit of debasement, like 2% a year. And in its conceit and ignorance, it believes that it can engineer this by just the right amount of credit creation. I mean, come on.
But as far as, again, the dollar's position as the world's reserve currency, number one, how much in jeopardy is that status? And is there any way of shoring up the dollar's status?
Yes, to both. The dollar is, people talk about the dollar a lot. They talk about how they don't like it so much anymore. And yet, if you look at what central banks themselves are doing, they are still adding. You're still buying, right? So the dollar, if it's going to be dethroned, must be dethroned by something other than criticism and grants. And so way off there in the margin, what I think something is happening, and that something is the awakening of the public in gold, and you can see this in the growth of the holdings of these exchange-traded funds that hold gold bullion in a warehouse someplace, and the one with the ticker symbol GLD especially is growing. And so I think that you can think of the gold price as the reciprocal of the world's faith in the person and the judgment of guys like Ben Bernanke and Jean-Claude Trichet at the ECB, and Gideon Gono at the Reserve Bank of Zimbabwe. So when people begin to doubt the capacity of these people to execute this dubious business model of fixing an interest rate, they begin a little at the margin to seek alternatives, such as the ancient legacy monetary asset gold. And I think it's very interesting and telling that these gold holdings of GLD, other ETFs, are on the rise.
So Jim, as far as gold is concerned, I had mentioned Peter Bernstein to you, who is a risk expert and a market historian as well, who recently left us. But one of the things that he said about gold is that it's an insurance policy against extreme outcomes. And he advocated that individuals should have a small portion of their portfolios in gold just in case. What's your view of as gold as an investment? I mean,
well,
what role should it play in our...
What Peter was saying was what the ladies of Boston say with regard to their hats. We don't buy our hats, we have them. And gold is kind of the guilty pleasure of the value investor. Note, it yields nothing, it earns nothing, has no book value, there's no conference call. It is a speculation on a set of outcomes, as Peter was saying. Peter wrote a very good book on gold. You can't know the price as we talk is over $1,000. You can't know whether that's too high or too low, right? There's no E attached to it. There's no yield attached to it. It is money of the mind in a way. So it could be $800 tomorrow, and the world might not have changed that much. So I have been buying it for years, and like the Boston ladies, I have it, and I expect I won't sell it because I don't trust these central bankers farther than I can throw them, and many of them are a little bit overweight. One couldn't throw them very far. But I think it is a speculation not on an extreme outcome, but on a reasonable outcome, which outcome is that these central bankers will overdo it. They are overdoing it. And one final thing, so important, one of the best investors I know treats cash not as a thing that you do as an afterthought, but as a steady state. Cash gives you flexibility. It gives you the means to exploit an opportunity that's presented to you through some discordant event in the world. You know, there's a calamity overnight in Pakistan, and the market sells it. With cash, you have an opportunity. If you are living in the country and you have some cash and your neighbor has to sell an adjoining piece of land, well, you have the flexibility to. So the world is cyclical. That will never change. Never mind these fake reforms that will be instituted. It will forever be cyclical, and people with flexibility, with cash, will be able to exploit those opportunities.